If you're over 50 and currently living in Florida, or even thinking about moving there, the next few names you hear could literally save you tens of thousands of dollars over the next year. This isn't hype, it's not speculation. This is real data, unfolding in real time, right in the middle of 2025. From Miami to Sarasota, rental prices in parts of Florida are plummeting, some by as much as 42%, a rate of decline we haven't seen since the 2008 housing crash. But here's the alarming part: many landlords haven't caught on yet, and some are finding out too late, after the damage is done. If you're retired, on a fixed income, or simply renting and looking for long-term stability, the cities that once looked like safe bets might now be financial traps, where rent hikes, poor timing, or shaky investments could cost you dearly. In this video, we're counting down 10 Florida cities where rental markets are unraveling fast, places where landlords are cutting their losses, panic selling, and watching their rental income disappear. Each location includes real numbers, in-depth insights, and warnings you can actually act on. And no, this video isn't just for real estate investors. If you're planning a move, trying to pick the right city to settle in, or just want to avoid falling into a bad deal, you need to see this. Because the next 10 minutes, they might save you from 10 years of regret. 10. Miami. Once a symbol of wealth, now the epicenter of panic. I'm losing almost $2,000 a month just to keep my condo from going into foreclosure. That's the raw confession of an investor in Brickell, Miami's once glamorous financial district, nicknamed the Wall Street of the Tropics. But in 2025, that kind of statement isn't rare. It's becoming the norm. What was once Florida's crown jewel for real estate investment is now buckling under the weight of a rental market in free fall, soaring ownership costs, and investor confidence that's eroding by the day. As of September 2025, data from Zumper shows median rent in Miami has dropped roughly 8% year over year, landing just above $3,000 per month. Still pricey by national standards, but nowhere near enough to cover the mounting losses landlords are facing. Despite offering aggressive incentives, free rent, $2,000 gift cards, complimentary parking, landlords are struggling to fill units. Meanwhile, vacancies are climbing fast. In just 2 years, the city added nearly 20,000 new apartments, pushing Miami's vacancy rate to a record 8%, a number Florida hasn't seen before. But the rental crisis is only part of the story. Ownership costs in Miami have exploded. The average condo insurance premium now exceeds $15,000 a year, 5 times the national average. And that's not counting the maintenance costs tied to Florida's updated building safety laws, introduced after the Surfside condo collapse in 2021. Some buildings, like 1060 Brickell, have been slapped with repair bills in the tens of millions. In that case, residents are being forced to raise $21 million, with fees doubling almost overnight. For owners, it's devastating. And then came the Airbnb bust. What was once seen as Miami's golden goose, short-term rentals, is now floundering. Tourism has cooled, and booking rates have plunged to just 40 to 50% occupancy. As a result, thousands of Airbnb hosts are either converting their properties into long-term rentals or selling at a loss, flooding an already oversupplied market with even more units. Miami's crisis isn't just about numbers, it's a cautionary tale. The city that once represented the ultimate real estate jackpot is now a stark reminder of what happens when optimism turns into overreach. If even a place like Miami, with its beaches, skyline, and global appeal, can collapse under pressure, then no market is truly bulletproof. 9. Cape Coral. From retirement dream to financial distress, how did a city once known as a peaceful haven for retirees transform into one of Florida's most fragile housing markets in just under 3 years? Cape Coral, the once prized coastal gem of western Florida, used to draw in a steady stream of snowbirds, budget-conscious homebuyers, and Airbnb hopefuls chasing easy passive income. But by 2025, the script has flipped completely, and what was once a postcard paradise is now a case study in market collapse. Today, average rent in Cape Coral has dropped nearly 8% from its peak, and 3-bedroom homes, once in high demand, are now sitting untouched for weeks. Even listings priced under $1,800 are gathering dust. The buzz of dependable cash flow has been replaced with the dead silence of empty inboxes and blank showing schedules. What's to blame? A tidal wave of overbuilding during the 2020-22 boom, which left behind a bloated supply. By Q3 of 2025, over 2,300 3-bedroom homes are listed for rent, more than 400 of them priced under $2,000 and still struggling to find tenants. Any property listed above that number? It's almost guaranteed to sit vacant for months. Rental activity has slowed to a crawl, and now a quiet price war has broken out. Landlords undercutting each other, offering to cover utilities, toss in perks, or drop rents just to get someone in the door. But that's just the surface. The real pressure point is ownership. Cape Coral's location on the coast has made it especially vulnerable after storms like Hurricane Ian. Since then, insurance premiums have doubled in many neighborhoods, and several insurance companies have stopped issuing new policies entirely. Combine that with mortgage rates that have nearly doubled since 2021, and leveraged investors are now facing chronic negative cash flow. On paper, some may still show returns. In reality, many are bleeding money month after month. Then came the Airbnb collapse. Between 2020 and 2022, investors rushed in, betting big on short-term rental profits. But in 2025, the landscape has shifted. Occupancy rates have plunged, nightly rates are down, and short-term rental supply has wildly outpaced demand. Now, panic is setting in. More than half of all listings in Cape Coral have already been slashed in price at least once. Home values have dropped by an average of 11%, and many owners are cutting their losses early, trying to sell before things fall even further. Cape Coral isn't just struggling, it's become a warning sign, a reminder that even the most inviting coastal markets aren't immune. When insurance costs spike, mortgage rates rise, Airbnb demand dries up, and renters disappear, even the sunniest dreams can become financial burdens. So let us ask you, had you considered retiring in a place like Cape Coral? And after hearing this, has your perspective shifted? Let us know in the comments below. And if you found this insight valuable, give it a like, share it, and subscribe, because here at Discover the Cities, we uncover the stories behind the sunshine. 8. Orlando. From vacation hotspot to Airbnb battleground. 3 months without a tenant, 2 months of free rent, and still no one signing the lease. That's the frustrated post of an Orlando landlord on a real estate forum, and sadly, stories like that are becoming all too common in 2025. What's unfolding in America's tourism capital has caught even seasoned investors off guard. Who would have thought that Orlando, home to Disney, Universal Studios, and millions of annual visitors, would become one of the hardest-hit cities in the rental market collapse? After the post-pandemic tourism rebound, many assumed the Airbnb gold rush would continue. But for thousands of short-term rental owners, the magic is gone. Units that once booked solid at premium nightly rates are now sitting empty for weeks, even months. The market is oversaturated, and as reality sets in, hundreds of Airbnb owners are converting their properties into long-term rentals, flooding the market with inventory the city simply doesn't need. Meanwhile, demand from traditional renters, students, professionals, and remote workers has dipped significantly since the lockdown era. So now Orlando faces the worst possible combination: soaring supply and shrinking demand. By mid-2025, median rent in the city had plunged 45% year-over-year, landing around $2,000 per month. For high-end apartments, the drop has been even steeper, some down 20% from their peak. Brand new luxury buildings now sit eerily quiet, many going 30, 60, even 90 days without leasing a single unit. The city's vacancy rate, once a healthy 3 to 4%, has now doubled to nearly 8%. A clear sign of oversupply and investor distress. To survive, landlords are turning to aggressive incentives: 1 to 2 months free rent, waived security deposits, free utilities and parking, even giveaways just to get potential renters through the door. Some leasing offices have literally turned into pop-up prize centers. And while large corporate landlords have the scale to compete in this kind of price war, individual investors don't stand a chance. Many are forced to slash their rents, remodel units, or throw money into upgrades just to stay in the game. As one local housing blog put it, incentives are back, and competition is fiercer than we've ever seen. Worse still, those who bought investment properties in Orlando during the 2021-2022 boom are now in a full-blown cash flow crisis. With high interest rates, rising maintenance costs, and rents in freefall, many can no longer afford to hold. The waited-out mindset is being replaced by a wave of panic selling, and listings from small landlords are rising fast. That's not just a trend, it's a sign of retreat. So what do you think? Orlando was once seen as a sure thing, an Airbnb jackpot. But in 2025, would you still invest here? Drop your thoughts in the comments. Hit like and subscribe to Discover the Cities for more deep dives into America's most volatile housing markets. 7. Fort Myers. When new buildings rise and the tenants vanish. It's the question echoing through real estate forums, investor meetings, and half-empty leasing offices all over Fort Myers. Why can't I fill a brand new unit in a neighborhood that's supposed to be booming? The answer? It's more chilling than most investors want to admit, because they're not the only ones desperately searching for tenants. Once hailed as the shining star of Southwest Florida during the post-pandemic migration wave, Fort Myers is now at the center of a quiet but dangerous housing crisis. From 2021 to 2023, the city saw a construction surge like never before. New apartment complexes sprang up seemingly overnight. Population spiked. Rents climbed. The future looked unstoppable. But by mid-2025, the market had turned on itself, strangled by oversupply and fading demand. In June 2025 alone, the number of available three-bedroom rentals in Fort Myers jumped from 515 to 697, a 35% spike in just 30 days. That's not growth, that's a warning siren. Entire apartment communities are now sitting half full. Whole rows of newly built homes stand dark and unoccupied, modern-day ghost neighborhoods. One housing expert compared today's Fort Myers to the early crash days of 2008. Naturally, rents are dropping. The median apartment rent now hovers around $2,120, about 6% lower than it was in 2024. In more suburban areas or for larger homes, rent declines have reached up to 9%. But it's not the price drops that scare landlords most, it's the silence. Many property owners still clinging to 2022 price expectations are watching their units sit empty for 60, even 90 days. And once the math kicks in, it becomes clear, holding out costs more than dropping the rent. The investors hit hardest? Those who bought in during the 2022-2023 frenzy, armed with high-interest loans and blind optimism that the boom would last forever. It didn't. Rents dipped, interest rates stayed high, and after Hurricane Ian, insurance premiums along the coast doubled. Add in repair costs, inflation, and rising maintenance fees, and many landlords are now in the red, even with tenants in place. Unless they can refinance or the market stages a surprise comeback, a wave of panic selling could slam Fort Myers in the second half of 2025. What Fort Myers is experiencing isn't just a dip. It's a critical reminder that rapid growth doesn't always equal sustainable growth. So what do you think? Would you take the risk in a city where vacancy is growing faster than opportunity? Drop your thoughts in the comments and don't forget to like and subscribe to Discover the Cities for more in-depth breakdowns of the housing markets shaping America's future. 6. Sarasota. The beachfront collapse. No one saw coming. What if I told you that rent in a sunny beach town once considered one of Florida's most desirable places to live dropped over 40% in just 12 months? It's not a headline from the next housing crash, it's already happening in Sarasota, and for thousands of landlords, it's no longer a theory, it's a financial disaster playing out in real time. By mid-2025, Sarasota, once the sparkling jewel of Florida's Gulf Coast, made national headlines for all the wrong reasons. The city just recorded the steepest year-over-year rent decline in the country. According to data from Stacker and House of Leon, average rents fell from the 3,290s in early 2024 to just 1,000. That's a staggering 42.7% collapse. Even allowing for some skew from smaller sample sizes, platforms like Zillow confirm the same trend. Sarasota's rental market is in freefall. Right now, the median rent sits around $2,500, down more than $300 from a year ago, an 11% slide that's left property owners scrambling. For a market that was red-hot just a few years ago, this isn't just a cool-down, it's a nosedive. So how did a city that was booming just 2 years ago fall this hard? It starts with one brutal truth: overbuilding. Between 2021 and 2022, Sarasota became a haven for retirees, investors, and Airbnb hosts. Everyone wanted in. Developers couldn't build fast enough. Multifamily projects popped up all over. Rents soared. People believed the good times would never end. But in 2025, the story flipped. Demand tapered off, and supply didn't. This year alone, the Sarasota-Bradenton metro area is on track to add 3,800 new apartments, the biggest surge in over a decade. Meanwhile, the vacancy rate has exploded to 16.5%, the highest level seen here in 25 years. As one local analyst put it, we went from zero vacancies to entire streets lined with for rent signs in under 24 months. This wasn't a sudden collapse, it was a slow fracture that no one stopped. Beneath the surface, there's a deeper vulnerability that most overlooked: Sarasota's aging population. The city has long drawn retirees, people on fixed incomes, relying on pensions or savings. When rents skyrocketed in the boom, many couldn't keep up. A lot of seniors left the area altogether. Others moved back in with family. The market lost one of its key pillars of stability. Now, while lower rents might seem like a lifeline to bring people back, it's not happening fast enough to offset the sheer flood of new supply. And the larger migration wave that once powered Florida's growth, that's slowing too. People aren't relocating at the same pace, and without a steady influx of newcomers, the market is left to wobble on its own. Sarasota's fall is more than a local event, it's a national lesson. A city once known for calm and stability has now become a cautionary tale about unchecked growth, runaway expectations, and the illusion of endless demand. The crash didn't come with a bang, it came with a slow, quiet unraveling. Did Sarasota's downturn catch you off guard? Let us know your thoughts in the comments. And if you're finding this series eye-opening, hit like and subscribe so you don't miss what's coming next, because the next city on this list is falling even faster. 5. Tampa. From Florida's hottest market to a cooling reality. Not long ago, Tampa was the poster child of Florida's rental boom, a city where prices soared and landlords couldn't list fast enough. But by the middle of 2025, that narrative has taken a sharp turn. Once celebrated as the fastest-growing rental market in the U.S., Tampa is now cutting rents just to keep units occupied. Back in 2021 and 2022, rents climbed at a blistering pace. Investors rushed in, confident Tampa would deliver endless returns. But those days are gone. Today, median rent in Tampa has dropped to around $2,100, down roughly 5% from last year. At first glance, it might not seem catastrophic, but look closer, and the cracks appear. Vacancy rates now sit between 6.5% and major jump from the tight 1.4% range seen during the peak boom. That shift means one thing: rental demand is slipping. And in response, landlords are scrambling. From large-scale apartment complexes to mom-and-pop property owners, everyone's offering incentives. 1 or 2 months of free rent, waived parking fees, upgraded appliances, and more. These perks used to be reserved for oversupplied markets like New York or LA. Now, they're standard practice in Tampa, a clear indicator that the power has shifted toward renters. But perhaps the most alarming signal isn't about pricing, it's about people. In 2024, Tampa's net migration, the number of people moving in, plunged to just 10,500. That's a massive 70% drop compared to 2023. Why the slowdown? Rising costs of living, insurance premiums that keep climbing, and wages that haven't kept up. Many families and professionals are finding it harder to justify staying in the city, and some are leaving altogether. When fewer people move in, demand dries up, and when that happens, landlords start to panic. So the question is this just a temporary adjustment in a city that overheated? Or are we witnessing the early signs of a much broader correction in the Central Florida housing market? Let us know what you think in the comments, and if you want to stay ahead of the curve as Florida's housing map continues to shift, like, subscribe, and follow along. We break down the real data so you can make real decisions before it's too late. 4. Naples. When luxury living starts losing money. When even Florida's wealthiest zip codes start hemorrhaging cash, it's a sign that the rental market has taken a serious turn, and Naples is leading that shift. Known as the crown jewel of Southwest Florida, Naples once felt invincible. A magnet for high-net-worth retirees, vacationers, and remote workers looking for beachfront opulence. For years, it seemed insulated from the ups and downs of the broader rental economy. But in 2025, the cracks are undeniable. Airbnb saturation and tighter spending among wealthy travelers have hit this market harder than expected. Many of Naples' upscale villas and luxury condos now sit empty for weeks, sometimes months at a time. Even a small drop in rental income here is a red flag, because for a market that prided itself on consistency, stability was part of the brand. But the rental slowdown is only part of the problem. Behind the scenes, ownership costs have surged dramatically. Along Florida's coast, home insurance premiums in 2025 have skyrocketed. In some areas, they've doubled, pricing out even seasoned investors. And that's not all. Property taxes and HOA fees have steadily climbed alongside rising home values, putting additional strain on anyone holding on to leveraged properties. What once felt like a safe investment, something that could at least break even month to month, has now become a financial drag. For many landlords, the numbers simply don't work anymore. As a result, a quiet retreat is underway. According to recent data from Naples area realtors, a growing number of villas and condos are being listed 10–15% below their peak values. The trend is clear. Investors who bought at the height of the 2021-2022 frenzy are now offloading properties at a loss, just to stop the financial bleeding. Naples, once considered a fortress of wealth and long-term value, is proving a harsh truth. No market is truly immune when profits dry up. So, here's the big question. Will Naples bounce back faster than other Florida cities, thanks to its affluent base and prestige? Or is this the beginning of a deeper correction, even in the luxury tier? Drop your thoughts in the comments, and if you're finding this series helpful, be sure to like, subscribe, and follow for more deep dives into America's shifting housing market. We bring you the facts, the trends, and the context you won't hear anywhere else. 2-3. Jacksonville, holding steady or falling behind. Is Jacksonville genuinely holding strong in Florida's rental storm, or is it simply sinking a little slower than the rest? At first glance, Jacksonville, often referred to as Jax, seems to be weathering the 2025 rental downturn better than its flashier neighbors. While cities like Miami and Sarasota are grappling with deep plunges, Jacksonville's rents have only dipped around 2–3% year over year. In fact, some pockets of the city haven't moved much at all, offering a glimmer of hope for cautious investors. So what's kept Jacksonville relatively stable? A big factor is its diverse economic base. Unlike many Florida markets that lean heavily on tourism, Jacksonville's economy spans healthcare, logistics, finance, and military installations. Plus, with plenty of undeveloped land and less reliance on short-term rentals, the city has avoided the more volatile swings. But scratch beneath that calm surface, and the warning signs are there. Between 2022 and 2023, investment activity surged. Out-of-state buyers flooded in, and home values jumped nearly 40% in just 3 years. That rapid appreciation set the stage for disappointment. Many investors entered the market with rosy cash flow projections, only to be met with 7% mortgage rates, flat or falling rental income, and rising operational costs. Now, those same investors are feeling the squeeze. Instead of earning passive income, many are now covering shortfalls out of pocket just to hang on to properties. Cash flow has turned negative, and monthly expenses are taking a toll. Meanwhile, Jacksonville hasn't escaped the building boom either. Around 8,000 new apartment units have come online since 2023, mostly in the city's outer zones. That influx of modern inventory is creating intense pressure on existing landlords. Older complexes and single-family rentals are being forced to lower prices or invest in upgrades just to stay competitive. While Jacksonville hasn't crashed like other markets, the balance of power is shifting quickly. What was once a clear landlord's game is starting to tip in favor of renters, with more choices, better deals, and growing leverage. So here's the real question. Can Jacksonville remain the exception to Florida's downward trend, or is this just the calm before its own storm? Let us know where you stand in the comments, and if this analysis gave you a new perspective, hit like, subscribe, and stay tuned. Every week we break down the real stories behind the numbers, because understanding the why matters more than just reading the stats. 2. Hollywood, Florida. Stuck in the middle and slipping fast. Tucked between the giants of Miami and Fort Lauderdale, Hollywood, Florida was once a quiet sweet spot, convenient, affordable, and just close enough to everything. But in 2025, the charm is fading fast. The numbers tell the story. Rents in Hollywood have dropped 9.5% year over year, making it one of the steepest declines in all of South Florida, second only to Hallandale Beach. And it's not just a blip, it's part of a growing trend that's hard to ignore. So what's behind the slide? It starts with regional pressure. As Miami slashed rents and piled on incentives, surrounding cities had to follow suit or risk being emptied out. Hollywood, caught in the middle, had no real choice. Renters are now more than willing to commute a few extra miles if it means landing a better deal or scoring a few months rent-free. That once critical location advantage, it's no longer enough to hold the line. But what really makes Hollywood vulnerable isn't just falling rents, it's how the city is owned. Unlike Miami's big corporate landlords or Fort Lauderdale's institutional investors, most rental units in Hollywood belong to individual owners, mom-and-pop landlords who often can't weather long vacancies. As the market cools, these smaller landlords are feeling the heat first. Properties sit empty for weeks, sometimes months, draining owners financially. More and more listings are hitting the market, and brokers say many now carry the same quiet red flag, unable to cover costs, selling due to negative cash flow. That's not a correction, that's a localized panic. And Hollywood has another challenge, an identity crisis. It's not a tourism hotspot like Orlando, nor does it have the economic engine of Miami. It's a middle ground city that in better times thrived on convenience. But when every city is offering deals, renters skip right past it. What was once a safe in-between is now looking increasingly expendable. So here's the big question. Can Hollywood find a way to stabilize, or will it continue sliding deeper into this regional downturn? Let us know what you think in the comments. And if you're finding these breakdowns helpful, hit like, subscribe, and follow for the latest on Florida's unfolding rental crisis. Because every neighborhood has a story, and knowing which way the market's moving could save you thousands. None 1. Boca Raton. When luxury starts to crack, when even the wealthy start walking away, it's a clear sign the market has reached its breaking point. Boca Raton, long known as a luxury oasis for remote working finance pros and high-income retirees, is now in full reverse. What was once a magnet for pandemic-era migration has become a flashing warning sign for overbuilt luxury living. At first glance, the broader market doesn't look too bad. Average rents are only down about 5%, but dig a little deeper, and the picture gets much darker. The high-end segment has taken a nosedive, with prices for luxury rentals dropping by more than 10% in just a year. Those towering high-rises that once had waitlists and pre-leased units, now they're struggling to fill entire floors. Developments completed after 2023 are offering every incentive in the book: 2 months free rent, utility credits, even influencer campaigns. And still, units remain empty. Some buildings are seeing vacancy rates as high as 15 to 20%, an astonishing figure for a market that once seemed bulletproof. Behind the scenes, it's the leveraged investors who are now taking the hardest hits. Many bought at the height of the boom, banking on continued growth. But with interest rates hovering around 7%, coupled with soaring insurance premiums, steep HOA fees, and rising property taxes, the math just doesn't work anymore. Negative monthly cash flow is now the new normal. As a result, condos are quietly hitting the market, with sellers willing to accept losses just to escape the financial drain. Boca Raton has become a textbook case of what happens when the top tier of the market gets too far ahead of economic fundamentals. The big question now is, will the luxury segment bounce back, or is this just the beginning of a much deeper slide? Which Florida city surprised you the most in today's breakdown? Are you currently seeing these changes where you live? Drop your thoughts in the comments. I read every one. And if this kind of real talk helps you navigate the market with confidence, be sure to like, subscribe, and share. Every week we bring you in-depth, honest looks at what's really happening in housing, because Florida is shifting, and knowing the truth could save you thousands.